Welcome to the monthly mortgage and housing email newsletter update brought to you by United Real Estate Capital. I have an email list and I'm checking it twice. I know which homeowners have been naughty or nice, and I kind of like the naughty ones. Let's jump right into the update. All right, we're going to first take a quick look at housing and see what it's done over the past few months. Okay, so back in June, I reported that the single family residence median sold prices were 898,980 for single family residences. That was back in June. Now they are 801,190. Well, this was actually as of a month ago, so they might be a little bit lower right now. Condominium median sold prices 678,000 back in June. As of a month ago, 621,080. And this is actually higher than expected. I was planning this a year ago when I was talking about this. I expected prices to actually be lower. The market's been pretty doggone resilient, which is probably why the Fed is continuing with this interest rate hiking. Although this month it was scheduled to be only a 0.5% instead of 0.75%. But then they're going to, the plan is to keep it around for longer because things have been, well, so resilient. Anyway, so that's the update on the housing for the single family residences and the condominiums. Let's go ahead and move on. All right, buying time is almost here. I would say a more of a ideal buying time is almost here. We were in a seller's market for about the last year and a half, as you probably know. This was typified by higher than normal prices, way higher than normal prices, and lack of inventory. Also, the time on the market, houses wasted no time selling. There were houses that sold within the same day that they came on the market. We have transitioned into more of a balanced market. Not quite there yet. In my estimate, maybe in another month or so, be in more of a balanced market. That's where inventory is in balance and home prices are at market value. We're just about there right now. So we're transitioning from that seller's market into that balanced market, and I'll talk about what will maybe happen next if we have a small recession. So, if we have a little mini recession, as I'm showing in this first bullet point, next year, sometime maybe first quarter of 2003, home prices should drop a little bit more. But we are not going to see the pre-COVID prices or prices like back in 2010. There will be deals to be had. So get ready for it because next year is going to be a good time to buy. Again, we're not going to see rock bottom prices like 2010 or pre-COVID. Next bullet point here. Less than 20% down payment should not be an obstacle. If you are considering putting 3% down, which is the minimum you can put down on conventional loans, or 3.5% down, the minimum for FHA loans. And by the way, both the FHA and the conventional loans in California are supported by Cal HFA. I'll make another video for that. There are restrictions, and that's the state-sponsored down payment assistance program. But I'll talk about that for another video. So back where I was, if you have a 3% or 3.5%, or maybe you're a veteran with VA loan benefits putting nothing down, or you're putting 10% down, anything less than 20%. My personal advice, this is Santa Doug's personal advice. I would not let that deter me from purchasing a home if I can get a fantastic deal on a home. There are tons of examples of this, but there's one that's just fresh in my head right now because it's the most recent. I had a young couple this year. They purchased a home in 2019, right at the beginning of 2019. And I believe it was about 370 something thousand right here in California. And the estimates, when I started running some numbers for it, in the beginning of 2022, I think it was around January or February, my estimates were coming up about 550 something thousand just in that couple year time frame. Well, got an actual appraisal done and it appraised for 580, which obviously that's crazy. That was, at the height of the insane seller's market pricing. It's dropped down, I'm sure, a bit since then, but still, probably still sitting close to $200,000, sitting on $200,000 in equity. What happened? What do you think would have happened if they waited? What if they waited? What if they decided not to purchase because they were dead set on uh, doing a 20% down payment because they didn't want to pay PMI, or someone told them that you don't want to purchase a home unless you can put down 20%. What if they waited? What would have happened? They would have been sitting there like a lot of people, um, you priced out of the market with these inflated offerings, and still sitting there at the kitchen table talking to each other regarding saving up enough money to purchase a home. But no, they did it, and they refinanced, got rid of the PMI, of course. When they put the minimum down 3.5% on an FHA loan, they had the PMI, or as FHA calls it, MIP, mortgage insurance premium. They got rid of that when they refinanced. So it's just an outstanding opportunity when you can get a fantastic deal on the home. So again, my personal opinion, I would not wait. In fact, that's how I got my very first place condominium. Purchased it with no money down, and next thing you know, it was at that boom happened, that boom back in 2000 that started in like 2003 or so, and next thing you know, sitting on 100 grand in equity, and then it just went from there. So anyway, I won't uh, spend so much more time on that point, but it just kind of hits close to home because I've seen so many examples of that, folks missing out on opportunities because they feel they need to save a 20% down payment. Next here, purchasing mostly based on interest rate. I see a lot of that also. That's why I want to address this. So many people overpaid for houses and condominiums because they heard that the lower interest rates um, impact home affordability in a huge way. And that is not 100% true. Certainly, the difference between a 3% rate and a 6% rate would make what, 400 or so dollars difference. I'm just doing this in my head on a $500,000 loan. Maybe a little bit more if the loan amount's obviously bigger. So maybe it's, let's say it's 400 and something to 500 and something difference in the payment, going from 3% to 6%, which, that's a massive difference. Normally you don't see differences like that. But let's just use that one for an example. Let's say it makes a 450 or 600 or $500 difference in the payment. Well, my personal thoughts are this. If I'm 450 to $500 a month away from not being able to afford my home, then I can't afford a home. I'm just not going to buy. If I'm that close, that's one emergency away from not being able to afford my home. That's one car accident. That's one medical emergency, whatever it is, just one. $500 away from not being able to afford a home. That, that just means I can't afford a home, period. So, and the biggest thing though that impacts the monthly payment is the price of the home. You go overpaying $100,000 like a lot of people did for a home, or even more than that, purchasing and at the height of a seller's market, well, you bet your bottom that's going to make the payment way higher than a difference in the interest rate. So personally, you all are grown adults. This is just my personal advice. Santa Doug has been doing this for a quarter of a century, and I personally um, would not purchase an overpriced home just because interest rates are good. That's me. All right, next here. Start preparing early. If you believe you have some issues that would prevent you from purchasing a home. If you're planning on purchasing next year when these good deals are going to be there um, for the picking, I would address that issue right now if it were me. Credit issues. I've looked at I'm being conservative. I'm going to say 5 to 6,000 credit reports over my career. It's probably a lot more than that because you're talking. I've worked for high volume lenders for most of my mortgage career, and at high volume lenders, pulling and examining 3 to 6 credit reports a day. That's nothing. Working 5 and 6 days a week, and out of my 25 years of doing mortgages, I worked for high volume lenders 11 of those years. And of course, that's not even counting the banks that I worked for. So, credit issues that I've observed, small credit issues take more than a couple weeks to do something about. So I would jump on that right now and have someone qualify you. See what the issue is so you can start working on it right now. That would be something that I would personally do. Again, you are all grown adults, I would imagine. So do what you feel is right. I would start working on it as soon as possible so I can be in a position to purchase. You won't be able to explain things to us, to anyone when it comes time. Like if there's something on the report, I've heard people mention things like, "Oh, I've had identity theft" or whatever it is. Well, the underwriter, the loan originator, the processor are not going to be able to just look at that and say, "Oh, that was fraud. We'll increase your score." They can't do that. Your score is going to be what your score is. So it's best you do something about it. Um, so you get the point on that one. You should get the point on that one. I won't belabor that issue, but I just wanted to drive home that uh, folks think they can fix that. Most folks think they can fix it in 30 or 60 days. Just figure the worst. It's going to take you a while. Start working on it right now so you can get something next year. All right. Let's go ahead and move on to the mortgage rate situation. All right. So what you're looking at on the screen here, this is the range of mortgage rates. This is the range of mortgage rates. You don't see this entire range of rates because lenders and banks and brokerages don't show you this entire band of rates, but this is the entire spectrum of available rates right now. They start at about 4.875, maybe down to 4.75, but right now they're right around 4.875, topping out at about 7.875, maybe even 8.125%. But you won't see things on this far end of the spectrum typically. Right now, let's see, let me break out my laser pointer here. All right. So right now you will see things probably maybe as low as 5.375 advertised, going on up, and you might see something as high as 7.125, maybe 7.25 being advertised in this range. So lenders can advertise what they want to. They advertise something that they feel is going to attract the most prospects. 5.375 down here is going to be a rate with 1 point, 1.5 point, maybe 2 points. Coming down on this end of it, 7.25 or 7.35, this should be something with no points and possibly, depending on the institution, a credit going back to you. For example, if it's a $500,000 loan, selecting this rate might give you a credit of, say, $4,000 here. So you'll see most of them right in this middle area today, right now. These rates are all available at every lender, every brokerage, every bank, every credit union, but they can choose to advertise which rate they want to. As the rate pricing goes up, they will change which rate they're advertising. This is subject for another video, what I'm about to tell you, but I'll just touch on it since this is a special in the last update of the year holiday mortgage and rate update. So I'm giving a little bit more information on this one. Um, you're actually shopping for fees. I know that those of you who have purchased a home before and those of you who have refinanced several times before, one of the first questions you probably asked is, what is your rate? Right? What is your rate? And that's actually, well, Santa Doug is here to tell you that's kind of a really bad question because these are all of the rates available. When you ask what is your rate, what a loan originator quickly does is looks at all of these available rates. They may be looking at, maybe they don't have this entire spectrum, but they have about 12 or so that they're looking at, 10 to 12 or 13 that they're looking at. And then they have to try to narrow it down to something that's going to best fit your situation based on what you tell them. And that's what they're supposed to do if a customer doesn't ask for anything specific. Now, again, this is information for another video that I have out, and I'm going to put an updated one out in regards to selecting the rate that works best for you. But let me give you just a little highlight. Some better questions when you're contacting a bank, a brokerage, a lender, a credit union. Much better question to ask would be something like, what is your 1 point rate? And that way you can compare their 1 point rate to another company's 1 point rate. Or what is your half point rate? Or what is your no points rate? Or what is your no cost rate? Oh, I'm sorry. And tell them if it's a 30 or 15 year or what. Let's assume it's 30. What is your no cost 30-year rate? That's a much better question than what is your rate? Or how about this one? This is one I prefer. Asking for a specific rate. That's taking into account that you have already found out which rate's going to work best for you. An experienced mortgage loan originator can help you find the rate that's going to work best for your situation, that's going to save you the most money. So, given that you've done that already, a much better question would be, this is an example, what is your 6.25% 30-year fixed rate cost? Or what is your 6.5% 30-year fixed rate cost? And that way you can compare the cost of their 6.5% 30-year fixed rate to the cost of someone else's 6.5% 30-year fixed rate. And again, I know it's hard to digest this because usually when you are dealing with these different mortgage companies, you only see one rate. Oh, let me show you something here. Let me pull up my website. This is a little bit impromptu. I didn't plan on doing this, but I actually feature a multi-rate pricing platform, and it makes it, my opinion, a heck of a lot easier for customers to get into the mindset of selecting a rate that's going to work best for their situation. So let me show you how. I already have it up here. So this is, let me get my big bobblehead out of the way here. All right. So let me go over to, this is the home page on my website. Let me go to the interest rate section. This is urecapital.com, United Real Estate Capital's homepage. Let me go to the interest rate section here. All right. So in the interest rate section, uh, let me blow my big head up over here again so I can talk to you. All right. So in this interest rate section that you see here, I feature a multi-rate pricing platform. I do this so for two reasons. One, like I mentioned before, so consumers know that they have choices. And one of these choices, when you do the math, I'm not talking about pulling this out of the top of your head. That's what so many people do. They don't do the math on this, or the loan originator is too lazy to do the math for them, or honestly, the customers a lot of times just don't want to listen. If the loan originator is trying to figure it out, they've just got something stuck in their head and they just tell them, no, this is what I want without doing the math. Do the math. Liars figure, but the figures don't lie. One of these rates is going to work best no matter what it is you're doing, whether you're purchasing a long-term home, whether you're purchasing a starter home, whether you're doing a refinance just to lower your payment on your mortgage, whether you're doing a refinance to lower the payment on your mortgage and bills, whether you're doing a refinance for home improvement, whatever it is you're doing, one of these rates, depending on what you're doing and how long you're staying in the house, is going to save you more money. So I list this multi-rate pricing platform like this so consumers can embrace that. Also, it's easier to follow what the rate pricing is doing. I mentioned a few minutes ago that what you're actually shopping for are fees. We all have the same interest rates. You can't call up Quicken Home Loans and say they're offering a 6% rate, and then you call up Loan Depot and they don't have it, or you call me and I don't have it. We all have it. You know, that same 6% rate or 5% rate or 4.5% rate, I have it. Your bank has it. Your credit union has it. Loan Depot has it. Quicken has it. Freedom has it. They all have it, but we have it at different prices. My 5% rate is going to cost different from Loan Depot's 5% rate, different from Quicken's 5% rate. You're shopping for the fees. And I know that's maybe a little contrary to what you've been doing, especially if you've refinanced before or you've purchased several times before. You were constantly probably asking about rate. And then you asked what the fees were. But what you probably didn't realize is that we all have the same rate. So this drives that home. The other thing is it's so, again, easier to track when you could look at the cost of multiple rates. Learn how the APR works. I have videos on the APR. In fact, listed right on my website. You can learn how to use the APR to actually help you shop. I even list the competitors' pricing on my website so you can go there and see and compare and learn. So check that out. Anyway, again, putting out a little bit more information, a lot more information than normal, because this is the last update for the year. So let's go ahead and move on and close things up here. All right. So in summary, purchasing based on interest rate instead of home price could prove unwise. So please remember that. Don't overpay for a house just because rates are great. Bullet point number two here, I'd like you to remember, choose a rate that best matches your short and long-term needs. Choose the rate that's right for you. I'm going to keep drilling that home to everyone. Anyone who follows me on my email list regularly and looks at my YouTube videos, you all will know so much more than the average home shopper and homeowner. I'm telling you, following me because I like to put out the real information, the accurate information, and the timely information. So things like this, just so many people don't know there's so much bad mortgage information out there. So choose the rate that works best for your scenario. Don't just ask what is your rate or just ask for a rate just because it's one that you thought of. All right, next bullet point here. Rates and home prices should go down if we experience a mini recession next year. But again, don't expect rock bottom prices. Don't expect the home prices of 2010 or 2018 or 17 even. Don't expect COVID interest rates, 2.75 and 3% rates on 30-year fixed with no cost. Don't expect that. There's going to be some great deals on rates compared to today, but you're not going to be down at the COVID lows. Okay. All right. So thank you so much for checking out this holiday review. of the mortgage rates and housing prices. I wish everyone a fantastic holiday, and I will see you next year on the January housing and mortgage update. Ho ho ho, and y'all take it easy. Reach out to me with any questions via email or just pick up the phone and call. There's a link to the website in the description of this video. Most of you have received this via email, though, so you can see my signature on the email. Take care, and y'all have a good one.